Hello and welcome to our guide to company cars. If you're thinking about how to run cars and vans through a business, there are many personal tax issues to consider. Over the next few minutes, we'll help you decide on the best option for you. If you're driving a car that's provided to you by your employer and is available for use personally, whether it's 1 mile or 100,000 miles a year, is viewed as a taxable benefit. The HMRC attaches a monetary value to the private use of the vehicle and collects tax on it, sometimes known as benefit in kind tax. Other people will call it P11D tax or perks, that sort of thing. There are two separate benefit in kind tables for cars registered after April 2020 and one for those that are registered before. Calculation of the tax is based on the CO2 emissions of the car provided, combined with other factors, the list price of the car, including accessories when new, your tax rate will be at 20, 40 or 45%, and the type of fuel that it runs on. The easiest way to work out the tax is to use HMRC's own car tax calculator, or you can look at the one on our website, and that'll help you through that, which will ask you for all of the pertinent details, such as I've just been discussing, plus any tax reducing facts, such as any contribution the employee or you may be putting in, although that's relatively rare. So to be able to do that, you need the car's list price, you need the CO2 rate that's applied, so that can be between 2% and 37%, and then you multiply the two together. So let's have a look now at the difference between petrol and diesel vehicles.
So the tax bill on diesel cars would typically be more expensive. There is a 4% surcharge. Because of their lower CO2 emissions, hybrid cars can be a great alternative. These vehicles will fall into a lower car tax band. If the vehicle classes as a van, the benefit is taxed slightly differently compared to a car. Instead of looking at the list price and CO2 emissions, there is a flat rate figure that HMRC provide. There is also the option of a zero emission van. This is an even smaller taxable benefit in kind compared to the standard company van.
You do need to, when you're thinking about company vans, you do also need to make sure that it qualifies as a van. A simple van, yeah, that's the right slide. A simple van, straightforward, 2 seats at the front, no space at the back, no windows, that's easy. But you then get into tricky areas like twin cab pickups, or even trickier, minibuses type things with 2 rows of seats, windows. There's been a few dodgy cases, so make sure that it is properly a van. But let's have a look now at how the fuel, your tax is affected by the fuel. So you can have a company car or a company van, and you can just be provided with the car itself and with no fuel for private use. So if you use it for business purposes, then the company can pay for the fuel. But then if you use it yourself, you have to pay for your own fuel. And that rate itself, the separate benefit in kind calculation, is based on the CO2 emissions. So again, you look at the CO2 emissions of your car, be it 2% for a wholly electric car or 37% for your latest Ferrari or Range Rover, and you multiply that by the flat rate. If it's a van, then it's just a fixed charge of around about £600 a year for being provided with fuel. So when people look at it, generally it doesn't make sense to have a company car provided with fuel, but it makes complete sense to have a company van provided with fuel.
Now, when we go into mileage rates, there are sort of different mileage rates as to whether or not the vehicle does belong to the company or not. So with some of our clients, what they can get a little bit confused about is they might try and claim, say, the 45 pence a mile mileage rate but then they've also got a vehicle in the business, so like a sole trader, and it is like either or. So when we're talking about sort of sole traders, for example, then you would have your vehicle in there, and then you'd have all your costs going through, and then you do a private use percentage, not the mileage rate. And also, if you've got a limited company, then if you've got the vehicle in there, you can't also have the 45p mileage rate, because some of that includes wear and tear, doesn't it?
Interestingly, just going back to the point I was talking about earlier with regards to if you've not got business fuel, then if you've got a company car and you do a business journey in it, you can claim typically 12 to 14 pence a mile if you've provided the fuel for a company journey.
Of course, you have to keep looking at the rates, don't you, for those?
They're always changing,
vary,
yes.
Whereas with the 45 pence a mile, it is always that, and then it's 25 pence after 10,000 miles. So if you use a vehicle for a genuine business trip, your employer can reimburse you using the HMRC flat rates. According to HMRC, trips are seen as business related when the work can't be done unless the trip is made, and the employee needs to be somewhere other than the usual workplace to carry out the job. So usual workplace is very important. If you've got, say, someone who's a contractor, so they've got a limited company and they're traveling to lots of different clients all the time, then they can claim the mileage rate. But for example, when I work in Cirencester every day, then you're not allowed home to work travel. So that wouldn't be allowable. So as Simon said, there are different rates depending on whether you use a company vehicle or a private vehicle. It's worth noting, if your employer reimburses you below these amounts, you can make a claim for the additional tax relief on the difference. So sometimes we can have clients on personal tax returns, they'll send the information in and they're getting reimbursed 35 pence, then they can claim an additional 10 pence per mile. It's also worth noting, if your employer reimburses you below these amounts, you can make a claim for an additional tax relief on the difference. So if you move on to the next slide.
Okay, let's have a little look at government grants. The government typically uses grants to change our behaviour and to encourage us to move in a direction that they want to do. So currently, there are two levels of grants available. There's a grant for the vehicle itself, so a small grant of up to £1,500 on a car up to £32,000. There's a grant of £2,500 for vans. And if you should be buying a truck, none of my clients have bought an electric truck yet, and you can claim up to £15,000 or £16,000. Plus, there is a grant still for putting in workplace charging, but no grants now for charging points installed at home.
So if we think about leasing or buying a company vehicle, this is always a question that comes up. And it can have a substantial difference on the amount of tax relief obtained. So in either situation, the benefit in kind position for your employees is not affected. So if you purchased a vehicle, you'd be able to claim capital allowances on it. This is a set percentage that can be offset against your profit, and it's dependent on the vehicle's CO2 emissions. Of course, if it's electric, you get 100% upfront. You certainly don't get the super deduction. If it's not electric, then it's written down sort of over a period of time. For hire purchase, it can be confusing between hire purchase and PCP. So I think with the PCP, it depends on whether, when you get to the balloon payment, is that a realistic market value? And that determines whether or not really it's HP or not. But if we just look at HP, the legal ownership of the vehicle passes to the company at the date the contract is signed. You will then simply pay for the asset over a period of time, normally on a monthly basis. The monthly HP payments will contain both interest and a capital repayment element. The capital element is not an allowable deduction against business profits, whereas the interest element is. You will, however, be able to claim capital allowances on the capital element of repayments, similar to if you purchased a vehicle. So if we think about the leases, there are two types of leases. There's an operating lease and a finance lease. So with an operating lease, you're basically renting the vehicle. The legal ownership doesn't actually pass to the company. All of the expenses incurred can be offset against the business profits. A finance lease is where the business is required to treat the lease in the same way as if it had bought the vehicle. The business will therefore depreciate the asset over its normal life and will charge depreciation and interest payments against profits. This is only one of the only times a business will get tax deduction for depreciation. In either situation, the asset is being borrowed from someone else, so no capital allowances can be claimed. Where the vehicle in question has a CO2 emission of 110 grams or more, only 85% of the lease costs are allowable. If your business is VAT registered, you can also reclaim 50% of the VAT relating to the lease of the company vehicles.
Interestingly, before we move on to electric vehicles, you can get 100% of the VAT for company cars on the maintenance charge. People often forget that. It's 50% of the actual capital costs, but 100% of the maintenance costs. Anyway, next slide, please. Let's have a look at electric vehicles. So, as we know, sale of new petrol and diesel cars is set to end by 2030. And when we wrote this, we didn't know that fuel would be going up to £1.85 a litre. But it's little wonder that people are more than ever thinking about changing to an electric car. Indeed, both of us here have got cars on order, electric cars on order. But before you take that leap, it's important to be clear about the tax implications of electric car purchase, be it on HP, PCP, lease, or just cash. You can just they won't let you pay by readies, but you can just make a bank transfer. If you try to turn up to buy your car with a bag full of £5 notes, they will turn you down and they will probably report you to the National Criminal Intelligence Service. So, can you claim capital allowances on the purchase of an electric car? Yes, as Charlotte said before, but the arrangements are different from those for a petrol or diesel car. And if you buy the car and you're not a limited company, they will be reduced by your personal use element of it. So if you are using the car 50% business, 50% private, you can only get half of the capital allowances. But if you're a limited company or a sole trader partnership using it 100% for business, then you can deduct the cost of the car from your profits before tax in the accounting period in which you purchased the vehicle. So profits of £100,000, you bought a car worth £50,000 in a limited company, you'll only pay tax on £50,000. Because you're likely to be able to reduce your profit substantially by this, it's worth making sure that you buy it in a year when you've got a good income. And if you're getting to the end of a year where you're getting, or you can see you've got a good income coming, then why not think about buying that car, assuming you can get delivery of it before the end of your business year. So can I reclaim VAT on the purchase of an electric car? Broadly, no, as we were just talking about, unless if you lease it, you can get 50% of it back, or if it does happen to be a taxi or something like that, you can also get that back. Let's also have a look at charging points. So the good news is that if you install a charging point at work, there's no benefit in kind. You can claim a deduction for the cost of installing that charging point against business profits. As Charlotte mentioned earlier, you can't get the super deduction on that. If you have a charging point installed at home, that is also deemed not to be a tax benefit. So there's no charge on the individual, and the business can claim tax relief on that as well. Other EV savings. So you have the fuel costs, which are much lower, but importantly, if the business provides electricity to the EV owner or EV user, that's not chargeable as a benefit in kind for tax purposes. Plus, of course, you can go into the ever greater number of congestion areas and ultra low emissions. So we've got one in Bath, there's one coming in Bristol. When I went into Bath in November, I had a letter from Bath Council a few weeks later to say, you came to Bath in your Land Rover. If you come again next year, you'll have to pay whatever it was, 10 or 12 pounds. So it did make me think not to go in it. So I now go in my blue, my VW Golf, which is a, well, what do they call it? Blue something anyway.
And you'll go in your electric car.
I'll go in my electric car when I get that. But there we are. One last point to think about when it comes to EVs is, of course, they are exempt from road tax. And if you look at the cost of putting road tax on some of the most polluting cars, it's not insignificant. So I think that's taken us through our sort of whistle-top guide to company cars and that sort of thing.
Yeah, thank you. So if you want to talk about that or anything else, then do contact myself, Charlotte, Simon or Helen. We now have 3 offices, one in Cirencester, one in Malmesbury and one in Fairford, and we're all there at different points in time. So you can always drop us an email as well at partners@mcgills.co.uk.
Thank you, Charlotte.
Thank you.